Welcome back to the channel and welcome back to likely one of, if not the biggest, wealth destruction periods of your God-given investment lifetime. Now, welcome back to the channel and welcome back to one of the greatest moments of wealth destruction that you have probably seen in your lifetime, at the very least, in a very long time. It's not pretty out there. Again, today, if you're invested in tech or long duration growth, meaning unprofitable long-term investments, you're not looking so pretty again today. CPI was not so good. Not at all. Core CPI month over month came in worse than expected. And we're going to talk about exactly what is going on, potentially when is the next positive catalyst. Because to be quite honest with you guys, I think a big reason why the markets just cannot catch a bounce is because we really have not seen any good news for a very long amount of time. I can't even remember the last time we had positive news. GDP report, bad. Inflation reports, bad. Initial jobless claims, jobless numbers, bad. Earnings, not great. Just everything's been bad. So that's what I want to focus in on, talk about what's going on today with the markets, AMC, everything you guys need to know. We have a couple Fed speakers that are coming up here in about the next hour. So let's dive into all of this key information. If you guys find value, if not simply entertainment, out of this video, hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. We do have some earnings here and after hours as well that I do want to talk about that could be pretty interesting, and a big data point tomorrow that is going to move the markets, I believe, in a substantial way. So let's dive into it. First and foremost, let's talk about CPI and what actually happened. Here's the headline for you guys. It says inflation. Oh, nope. Don't mean to do that. Pause. Okay. It says inflation barreled ahead at 8.3% in April from a year ago, remaining near 40-year highs. The consumer price index accelerated 8.3% in April, more than the estimate of 8.1% and near the highest level in more than 40 years. Core CPI, which excludes food and energy, was also higher than expected, rising 6.2%. Shelter costs, which comprise about 1/3 of the CPI, rose at their fastest pace since 1991. Inflation-adjusted earnings continued to decline for workers, falling 2.6% over the past year due to the surge in cost of living. So essentially, just to throw out some numbers here, right? If you actually lost 2.6% of adjusted earnings, that means if inflation was, say, 5%, right, and you increased your earnings by, 3.4%, well, you still lost 2.6% because inflation was 5%. So that's what that is, long story short, if you guys are a little bit unfamiliar with inflation-adjusted earnings. And that's not a good thing, obviously. That means even if you're paying people more, they're still not making as much. Their buying power is still decreasing. But what is the most concerning metric of this whole report? Well, it's core CPI month over month. Right here is the last number that we got. 0.3% month over month gain. What was the report today? A 0.4% month over month gain. Not good at all. Or a 0.6% month over month gain. It was expected at 0.4%. So not good. The month over month increase. So this does not look like the peak of inflation. At least that's the conclusion that I am hearing on Wall Street, and that's what the data is really saying. That's why the markets are very choppy today. People are trying to look at this with some light and say, hey, we're still going down. We're still not at the highest levels. Hopefully the Fed will do something and maybe not act aggressively, right? Maybe a lot of people are just smoking hopium at this point, or maybe, you know, a 0.4% bounce is nothing in the grand scope of a 27% drop on the NASDAQ. And to see a little bounce today after heading into CPI at the lows of the year, is it warranted to see a bounce here? Probably. But we need some kind of positive news to actually get a bounce and to actually hold up some kind of small short-term rally. And it's very possible by the end of the day today, you could be up or down 2%, 3%. That's definitely in the cards. Now, Why is that? Well, we have some data that comes out tomorrow that is going to be very important as well. But here in just a couple of minutes, in about 34 minutes, FOMC member Bostic speaks. And this is something that we need to pay attention to when these Fed speakers speak, because it does move the markets and it is very important, especially a voting member like Bostic. But at the same time, the NASDAQ is down about 27% year to date, and it's down again today, so it might be down a little bit more than that, around 27% since the start of the year. Now, in my personal belief, the Fed wanted to restrict capital like a damn boa constrictor, but not at this aggressive pace. Keep in mind the Fed's dual mandate of price stability and maximum employment. Price stability means keeping inflation under control, keeping inflation expectations under control, and maximum employment meaning that everybody that wants a job can go out and get one. And it's pretty clear that price stability, they're not doing so good at. Inflation has been crazy. But maximum employment is there plus some. The labor market is too hot, and that is adding to inflation, which is making their second mandate, price stability, a lot harder to achieve. For an example, if there is too few people, fighting for the same job, there's too many job openings, then employers have to pay more to get somebody to fill that position. And then what does that lead to? That leads to more inflation, because if you're a McDonald's worker, for an example, and you need $15 an hour to come to work, well, McDonald's is going to have to raise their prices, and that's going to hurt inflation. That's going to make inflation higher. At the same time, when the stock market, like we've seen, has fallen 27% in the first 5 months of the year, one, you get less people that actually want to retire. Odds are, if you were heading into 2022 and you did not set up your portfolios in a certain way to retire, you're less inclined to actually do that now, as a lot of paper wealth has vanished. That's leading to an even tighter labor market, and it will lead to a tighter labor market for a longer amount of time. Now, at the same time, let me ask you, how many IPOs have you seen in 2022? Not very many. People do not like to IPO in a bear market. When markets are falling through the floor 4, 5, 6% on the NASDAQ a couple times a week, people don't like to do that. Companies don't like to do that. So startups that are trying to grow their business and actually, get capital from public markets, because after all, that's what the stock market is for, is to raise capital and then go out and build your business in reality, right? In real life, per se. That hurts economic expansion and economic growth a lot as well, and leads us to a greater chance of actually seeing a recession or a soft landing. So in my personal view, the Fed wants the stock market to come down, but they don't want it to come down 27% in 5 months. Maybe 27% in a year and a half. That's more reasonable. Now, we have not been getting any good news, like I said. So that's really the thing. Potentially, I want to see if some Fed members start to come out and say that we've done enough tightening, maybe we should hold off type of deal. I think they want the stock market not necessarily to go back to all-time highs or see a huge rally, but I'm inclined to believe that they don't want the stock market down 27%, so they can just say something. They can, say something along those lines, that they've done a lot of the tightening already, right? That would give the markets a boost. That might give a little bit more stability to the markets, even if they don't do a thing. So that's kind of what I'm looking forward to some degree, especially if the markets do continue to drop at this pace. We'll see how this hashes out by the end of the day. But 2018, 2019, that's exactly what it was, right? This was the taper tantrum. The markets started to freak out. Interest rates were going through the roof. The 10-year treasuries were, at like 3.4%. That's where we almost, topped out at just recently. Treasuries have come down just a little bit, now sitting just under 3%. But the Fed, wanted liquidity to restrict back here 2018. Really, like, the bottom was literally Christmas Eve 2018. But they wanted this to happen, but not this aggressively. And then they came out and basically jawboned things back to reality, just said a couple things and kind of pivoted, and the markets were fine after that, right? So I'm inclined to believe that, but it's not something that I'm going to 100% stand on. It's not something that I think is going to happen tomorrow. I think the lower we go, the odds of a Fed that kind of starts to U-turn becomes more realistic, right? It's just not good to have a stock market down this fast and this aggressively. It's just not good at all. Either way you put it. For the Fed's mandates, it does not help anything. So that is that. And then, like I said just previously, we do have PPI data that comes out tomorrow, which is producer price index month over month. That's going to be very important. It's expected to come out at about 0.5%. Last month was 1.4%. So it was very, very bad last month. That's like an annualized rate of like 13 or 14%. Not good. This would be an annualized rate of about 6%, which would be a lot better if that month over month comes in at 0.5%. That could potentially be the first bit of good news that we have seen in a very long time. Now, on top of that, you do have initial jobless claims as well, and I don't really think the markets are going to pay too much attention to this. Then again, it does, obviously show you glimpses into the labor market, which could be important, but I don't think that number is going to be too big. Last month it came out at 200,000. This month expected to come in at 195,000. Actually, if jobless claims do go up in a weird way, that could be seen as somewhat bullish for the labor market and specifically for the stock market. So that's really what we have setting up for us. You do have more Fed speakers tomorrow as well. FOMC member Fed Dally, she speaks and she tends to be more on the dovish side. Her comments last time she spoke was not. So we'll see if there's a change of tone here after the markets have just gotten destroyed. And then on Friday, you have Kashkari. He speaks, as well as Fed Mester that also speaks. So I think the Fed speakers are going to hold a little bit more weight here to kind of give the markets a little bit of a glimpse of what could potentially happen next with Fed policy, especially because the markets are down 27% in 5 months. Typically, that does not happen even in a large rate hike cycle like we see right now. Typically, the markets actually start to fall in a dramatic way when you're much further along into a tightening cycle. So that's really, kind of what we're looking at over the next couple of days. Bottom line, I think the Fed will eventually pivot. The lower we go, they will probably try to come out and make some claims like, hey, we're going to kind of raise rates these next 2 times, and then we're going to see where things are at. Keep in mind, the markets are pricing in 4 back-to-back 50 base point rate hikes. So if that were to happen, that would be extremely bullish for the markets. I wouldn't expect all-time highs. I wouldn't even expect 15% rally or more. 5-10%, that would be healthy. That would be a healthy kind of breather for the markets, and I think that's actually what the Fed wants right now. It's all about the pace of tightening, and the way that we are going right now, you're going to screw the economy, you're going to screw the stock market, you're just screwing everybody at that point, right? And it is a midterm year, so there's going to be a lot of pressure on, obviously, Fed Powell from Biden, because one, inflation's not good, so that's a problem heading into midterms. And don't think for a second that the stock market being down 27% in 5 months is not going to affect the way people vote. It 100,000% will. So there is a very strong incentive, at least by the federal government, to make the stock market at least a little bit happy, especially around midterms. And midterms tend to be historically very good years for the stock market. We'll see, obviously, no guarantees. I could totally be wrong with this whole philosophy, but I think enough has been done already, and I think it's been done a little bit too fast in the Fed's eyes, and especially in the government's eyes. People are not going to be happy when they look at their retirement accounts and they're thinking, damn, I can't retire for an extra 5 years, when in all reality, probably not the case, but it does start to affect the way people vote, so on and so forth. So it is pretty important, especially this year, to at least have the stock market neutral and stop dropping. If you could just stop dropping, I think that would do a lot for the psyche of a lot of the voters out there. So That's kind of my opinion. Obviously not financial advice. Anything can happen, especially here in 2022. As you guys could see, we could end the year at all-time highs, or we could end the year down 30 or 40%. That's kind of the way that I look at it right now. Either this thing is going to run through the floor, or we're going to see a substantial bounce, and we could, end the year, down only 10%. We'll see how it all ends up hashing out. Now let's talk about AMC and exactly what is going on today. And before we get into that, I really want to point out Apple and Microsoft. Apple and Microsoft are the single biggest stocks that weigh on the markets, and these suckers are down over 1% a piece. So if you see Apple and Microsoft actually come back by the end of the day, you could see a very strong day today. If they are unable to, then you're going to see them a bit grounded for a while and kind of holding back the overall markets. Literally, if you look at these on a 1-minute candlestick chart, they virtually look the same, right? Little bit of variations here and there, but they essentially are the S&P. Like, they essentially control the whole market. So that's going to be key, and that will also help to boost up AMC if those stocks can also rally. AMC is down about 6.88% today. A lot of stocks are down quite dramatically. I'm really not surprised by this. We tend to sell off initially after earnings come out, and then we do tend to rally about 2 to 4 weeks after earnings. That's historically what tends to happen here over the last call it year and a half. So we are heading down to a very important key technical level at about $10 per share, and I've been saying that this is bullish the whole time, that you need to see financial conditions really constrict and capital to become, one, more expensive, but two, just more scarce overall, to actually force shorts to cover. And I plan to make a video on that today, exactly why that is the case, because I think people need to understand this. Some people watch other people and they get emotional and they don't really put things in the right context. This is actually very bullish for AMC, believe it or not. This is what you need to see to get margin calls for the hedge funds, and then to see hedge funds actually cover on their short positions. But overall, not a very good day. Let's just call it that. Down now 7.35%. as the S&P is starting to sell off a bit more aggressively. Now let's take a look at the Ortex data, and we can see the short interest of free float is skyrocketing again after earnings, almost at 21%. The current shares that are sold short of 108.04 million, cost bar max of about 3%. You can see borrowed shares for the day at 7.36 million. The share utilization is at 100%, and the days to cover is sitting at 2.85. So the short interest is really starting to balloon yet again today. 21%. That's pretty damn high, and that's pretty excessive in my personal opinion, even when you do factor in that the puts that are being placed on AMC that are in the money or close to the money, those pretty much cause the market makers to instantly go out and short the stock to hedge for those puts, and that is not reflected in the option activity, but it works the same way, right? So when they buy puts, it makes the market makers have to go out and short stock to potentially oblige for those puts that do get assigned, that do stay in the money by expiration. We get that. Now, when a stock like AMC sees a substantial bounce, maybe it's 5, 10, 15, 20% in a day or a week's time frame, the market makers can then go ahead and buy back their stock on the open market just to de-hedge all of the puts that they have had to hedge for. That is a reverse gamma squeeze to the downside, and then a gamma squeeze. A little bit different when you're talking about, a short squeeze, a gamma squeeze in that sense, but it works the same exact way. And that's potentially what could help fuel a substantial rally to the upside when something positive happens. There's been nothing positive, like nothing has been positive as of recently. So there hasn't been a real big reason to actually, see the markets have a reversal. Like nothing has been good. So it's not a big surprise here. But after all, AMC earnings were good. Like, they were good. They beat all analyst expectations across the board. They said, 2022 and 2023 are going to be great years. There's a lot of demand, so on and so forth. The movie slate is looking really, really good heading into the end of the year. But what happens? Shorts come out and increase their short positions by millions of shares. That's kind of the market that we are in right now. Well, the option activity for the day is sitting at 4 orders totaling $4.31 million. It says positive order value of 81%. I don't really see that right here. If you look at individual orders, you can see a lot of puts that are coming through on the option chain, some of them for very large amounts, but this is pretty interesting. July 15th, $15 calls. Bought those for $1.34 a piece. So a break even of $16.34 by July would imply a substantial rally, since we are right at about $11 per share, and that is the single largest order that I am seeing for $710,000 for that single order. Definitely the largest order we have seen in quite a while. So that's pretty interesting. That's an interesting option order right there nonetheless. Now, AMC stock is just going to be victim to the markets for a while, and I'm going to make the video again later on today to really talk about this whole situation and how this is bullish for AMC. And I think that's going to be a very important video for everyone to pay attention to, right? Because not everybody gets that same context if you don't watch the channel. Overall, watch for that Fed speaker today. See what he says. See if he boosts the markets up. You want to see the tone. If Fed Bostic in 4 minutes is good, which will be at about noon, so you'll see what happens in the markets, whatever statements come out. We'll see. I don't want to get anyone excited, but the further this thing goes down, the more likely you are to see the Fed actually start to say a little bit more positive things to try to help the markets out, or at least stabilize the markets. So that is going to be all for this video. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Come join us on the live stream in between 10 and 11 p.m. Eastern Standard Time. We will be live tonight talking about all of this and much more. If you guys want to come trade with me live in real time, link down below in the pinned comment. You guys enjoy the rest of your day, and I will see you in the next one.